Hello, my name is Josh Schneider with Ever Oak Wealth Company and Cetera Wealth Services. Thank you for joining me to discuss retirement contributions, pre-tax versus Roth. Every retirement account has a silent partner, and that partner is the IRS. For some accounts, the IRS gets paid later. With others, they've already been paid and are completely out of the picture. As it relates to your retirement savings, understanding whether the IRS is your future partner or already bought out comes down to pre-tax versus Roth contributions. When you contribute to an employer plan like a 401k or 403b, you often have two options to consider. The first option is with pre-tax contributions. This approach reduces your taxable income today, growth is tax deferred, and withdrawals are fully taxable in retirement. The second option is via Roth contribution. This approach is made with after-tax dollars, growth is tax-free, and withdrawals, as long as they are qualified, are completely tax-free as well. So remember, pre-tax is a tax break now, and Roth is a tax break later. Also note that any employer money contributed to your account is typically made with pre-tax dollars. The decision usually comes down to tax rates over time, not investment performance. Pre-tax may make sense if you're in a high tax bracket today, you expect lower income in retirement, and you need the current tax deduction to improve cash flow. Roth may make sense if you are earlier in your career or in a lower tax bracket, you expect tax rates to be higher in the future, you value tax flexibility in retirement, you want to reduce your future required minimum distributions, which are those mandatory withdrawals that often start in your 70s. Remember that no one knows future tax rates, but we can control tax diversification. For many people, the best answer isn't either or, it might be both. Using a mix of pre-tax and Roth can create flexibility in retirement income planning. It can help manage Medicare premiums, Social Security taxation, and reduces your reliance on one future tax outcome. In retirement, having both buckets lets you choose where your income comes from rather than letting the tax code decide. When is Roth money truly tax-free? This is critical and often misunderstood. For a qualified Roth distribution, two requirements must be met. The first is the 5-year rule, meaning the Roth account must be open at least 5 years. The second is an age requirement. You must be age 59 and a half or older. If both are met, then contributions and earnings come out tax-free. If not, then contributions come out tax-free, but earnings may be taxable and subject to penalty. Note, there are other qualifying events such as disability or death which may warrant further attention and review. Pre-tax and Roth are tools and not predictions. The goal is flexibility, clarity, and confidence when accessing your money in retirement. So consider the tax bracket you are in today and what your income may look like in the future. Also consider your time horizon. Typically, the longer the time horizon you have until retirement, the more appealing Roth may be since there is more time for potential growth, ultimately accumulating the maximum tax-free earnings. Lastly, consider your unique situation and preference. I want to remind you the most important thing is contributing an impactful amount towards your future. Whether that is pre-tax, Roth, or a combination of both, you are doing the right thing. Thank you for tuning in.